Welcome, you're watching the NWR Virtual Resources Conference, May 2020. On the line, we have Paragon Funds Management. Paragon is an Australian long-short fund manager passionate about investing. Paragon is currently dedicated to one fund, the Paragon Australian Long-Short Fund, which comprises a portfolio of thematic-led, fundamentally driven, bottom-up, high-conviction stock picks. John Deniz co-founded Paragon in 2012 and is responsible for executing the investment strategy and managing the Paragon Australian Long Short Fund. John has over 20 years of relevant industry-specific experience, including 14 years in financial markets. Prior to establishing Paragon, John worked at Management, a global resources absolute return fund, as a key member of the investment management team. Over to you, John. Over to you, John, with your presentation for Paragon.
Great, thanks for the intro, Laura, and thanks all for joining in on the call. Today I have a few slides on our gold thesis and why we believe we have the perfect storm for a major move in the gold price and our gold stock picks. Just briefly though on us, Paragon, we've been going a little over 7 years. We manage the Paragon Australian Long Short Equity Fund. The investment strategy is long short Aussie equities with a focus in resources and industrials. We have an all-cap mandate and we're completely index unaware. In terms of our investment process, we're very much thematic-led, looking for strong economic tailwinds like we see for gold right now, and we're fundamentally driven. And we run a concentrated fund, basically allocating capital to our best long and short ideas. So over the page, in our view, all the key catalysts are in place for a major move in the gold bull market. I mean, let's just think about them. We've got cash rates at zero, very low bond rates, negative real rates, and falling further. Unprecedented fiscal and monetary responses led by the US, but of course, it's the same for China, European and Japanese central banks. Japanese, of course, the most recent to come out with unlimited QE. And what I've got charted on the right, if we just narrow in on the US monetary response, QE4 announced fairly recently, it's already bigger than QE 1, 2 and 3 of the GFC. Fed's balance sheet in the process, of course, as you see in the chart on the right, it's already almost 8 trillion US, that's 38% of US GDP. Not that dissimilar really when you look at these ballooning balance sheets by central banks, from whether it's Japan or Europe. And then of course the unprecedented level of US fiscal stimulus announced, of course, to take on the COVID-19 impact. A US $2 trillion bill announced recently, that's 10% of US GDP, double the initial response in the GFC, and there's talk of another $1 trillion bill underway. And why, of course, is that important? Deficits, twin deficits, both budget and trade. We saw them being a huge driver for the last gold bull cycle. Today, of course, twin deficits in the US are 7% of GDP, and they're likely to more than double. And remember when they got to 12% of GDP in the last gold bull cycle, gold hit a record high of US $1,900 an ounce. I'll go over the page just to try and illustrate these key catalysts a little further. It's a busy chart on the right-hand side, but I've essentially graphed some of these key drivers at play in the last gold bull cycle. We'd all remember, and some of us have invested through that epic cycle that ran from November 2008 to September 2011, when the gold price almost tripled. It ran from, I think, US 700 an ounce to, as I said earlier, over 1900. And what you see here in yellow is US dollar gold price. And in red, that's just the S&P 500 declining through the GFC. In green, one of the key drivers, US real rates. As you can see from around November 2008, it peaked, but then fell precipitously. Basically, real rates collapsed. I haven't superimposed on this chart US 10-year bond rates because there's too much going on in this chart, but US bond rates fell almost 60%. As you can see in the blue line, cash rates were cut aggressively to zero, a bit like what we have now. And the other key driver here, not included in this chart, but of course very important, QE1 that was announced November 2008, basically at the bottom of that secular gold bull run start cycle. And then of course QE2 was announced in November 2010. Again, I haven't graphed the twin deficits, but if I had to superimpose that on this chart, you would have seen them blowing out to peak at 12% when gold peaked in September 2011. If we go over the page, we're clearly of the view here that history is repeating itself, and the GFC is a very good analogue, as I've touched on already. But what we've got here tabulated and charted on the right are the previous 12 gold bull markets, and you can see the percentage changes in the gold price in the middle column within the table on the left-hand side, and then the percentage move in the gold price. And as I said earlier, almost a 200% move in the secular gold bull run coming out of the GFC. And if you look at that, if you compare that to where we are today, and where we'd argue we've got where the common catalysts are even more pronounced in terms of setting up for a bigger gold bull run this cycle. You can see shaded in yellow, gold's up almost 50% since August 2018. The change in the equities, of course, the GDXJ is almost 100%, but we think this move is in its infancy, and we've been pretty vocal about this in our monthlies and in other presentations that well, it's not really a big call for us to be saying that we expect gold to break all-time highs when gold's already at almost 1,700 US an ounce. And we expect it to break all-time highs in the short to medium term. Again, over the page, just to get a visual on US dollar gold and Aussie dollar gold, which of course is key driver to the Australian gold names. As you can see in yellow, US dollar gold on the cusp of breaking all-time highs, very quickly recovered from the rapid sell-off that we saw in late February and March. Of course, Aussie dollar gold, it continues to break new highs, as you can see in the dashed blue line, currently at almost 2,650 an ounce Australian. That's great. It's providing a great setup for ASX listed gold equities, and there's select names that are generating today greater than 100% margins, and basically have become cash machines. Now, our focus when you have this sort of setup, if you think gold's going to be stronger for longer, and of course, if you've got limited capital like most of us have, you want to be allocating your capital to what you think will be the best performers in an environment like this. And in our view, when it's stronger for longer, as we see for gold, you want to be across the spectrum of stocks. And so the best performers will be what we think are attractively priced, preferably unhedged, low cost, mid and large cap producers. And I'll talk about a couple of those shortly. But the biggest gains, no doubt, will come from discovery delineation plays, call it emerging developers that are, have near-time production, fully funded and looking to start up an asset in the short term, say the next 6 to 12 months. And of course, even high cost leverage producers will do well in a rising gold price environment. Over the page, I'm sure you've all seen the typical share price life cycle of a high quality resources investment. We tend to focus in phase 1 and phase 3. So phase 1, the discovery delineation phase, and I've just superimposed on this chart where you might like to enter. And I've got a couple of our longs today that we own in the fund, Sky and De Grey. We tend to avoid the second phase of this chart, call it the non-eventful later stage feasibility funding construction phase, but definitely then interested in the third phase of this chart, where we're looking to invest in pre-production, near-term production, ramp up producers and growing producers, and I've superimposed again 3 of our names: Ora Banda, very much near-term production; West African, of course, ramping up at Sanbrado Gold Mine; and Alassa, which is world-class in our view and growing its production. In red is Newcrest. It's we're not short anymore, but that's an example of a name where we don't want to be in a producer that's got declining production and complex assets. Again, so just going through a couple of our examples that basically illustrate the spectrum of stocks that we want to be invested in this gold cycle. We've done very well in some of these names already, and we think the re-rate continues. And so in terms of a large cap, growing large cap producer that's unhedged, very high margin because of their low costs, and with a world-class asset, Alassa's asset basically has an 18-year mine life, which I think is unrivaled. You'll only see that sort of mine life out of a Newcrest. But Alassa, it's one of only 2 names that we can find on the ASX in terms of the gold peers that are unhedged and realising the current strength in the spot gold price. Arguably the lowest cost producer on the ASX, and despite its re-rate, it's only trading on 6 times free cash flow. And on our numbers, will generate, because of their 5% cash tax rate, they'll generate over 350 million over the next 12 months into free cash flow. And that's on par with what Saracen is set to do, to generate over the next year. However, Saracen's, of course, twice the market cap. The next example, a mid-cap producer that's been going well for us and we think it continues, is West African. They've just started producing out of their Sanbrado gold mine in Burkina Faso. Again, they're virtually unhedged. They've got a setup where there's a slight clip on the gold price received over a prevailing month, but they're effectively unhedged. And we think West African's essentially going to be another Alassa for us. And just quickly, Alassa, we bought that January last year as their key asset was ramping up, and of course the operating and financial leverage unwind drove that share price to triple. And West African is already re-rating. Of course it's got a solid amount of debt, but if you look at the free cash flow that they should generate by the end of fiscal year 21, we're seeing the same thing as Alassa. There's strong financial leverage, debt unwind, and we expect the stock to be debt-free by the end of fiscal year 21. And just think in the EV, the debt value should get swapped for equity value, and so we think we're well placed. And then finally, the last example in that first phase that I showed you on the prior chart, we think De Grey is easily the standout discovery delineation play on the ASX. They've made an exceptional gold discovery at the Hemi prospect in WA. Hemi, on our internal modelling, is already over 2 million ounces, and it's still open in many directions. And it's a great ore body. In fact, it has many ideal ore body attributes in that the gold starts from surface. It's the main zone at Brolga. It's really wide. It only has a slight dip, and so on our modelling, there's going to be a very high percentage in terms of resource conversion to mineable ounces. And if you add the over 2 million ounces they've delineated already to their historic resources, which are already over 2 million ounces, so that's 4 million in total, all within they'll be within a radius of a mill, no further than 25 kilometres. De Grey is in our view, the emerging development story. They're still busy drilling and discovering essentially more gold at nearby untested targets. And so whilst it's gone exceptionally well for us, we think there's plenty left in the run for this stock. Just on the left, I've charted the ASX gold peers, not all of them, but basically the ones that we think are worth following. And there are several names there, as you can see. What's interesting in this chart, and I should say it's normalised from the 23rd of March, basically the bottom of the gold sell-off from the recent market crash and call it equity markets bottom. As you can see, there's been a strong recovery in many of the gold equities. Interestingly, the US dollar gold price in dash green down the bottom and the Aussie dollar gold price in dash blue just above it haven't are next to unchanged, yet you can see the equities have had a fairly strong re-rate, many of them recovering the March crash and back at new highs. And pleasingly for us, as I said, when you've got limited capital, you want to be assigning capital to the best names. And we're pleased that of the top 5 performers, which are Sky, WAF, OKU, De Grey and Alassa, we're pleased to say that we've been long 4 of the top 5, and as I said earlier, we think there's plenty to go. As I said, short presentation, that's all I had. I'm happy to hand over to any questions.
Thank you so much for that, John. Got some questions that have come through as you've been speaking. You did mention at the start of the presentation that you expect gold to break all-time highs in the short to medium term. And given equities tend to outperform in percentage terms, as we've seen historically, what can you maybe go into a little bit more detail around another one of your preferred equity exposures right now? You spoke a lot about De Grey's, but if there's another one you'd like to single out besides the 3 on that slide there.
Sure. Look, to your point at the start, the gold equities tend to, the leverage to the move in the gold price tends to be 2 or 3 times, hence why we're excited. But another example, say in the first phase, in the discovery delineation phase, well, the best performing stock on this chart is a name called, since the March 23 bottom, is Sky, and they've made a very interesting discovery in New South Wales. They're currently drilling. They smartly acquired this asset from another resources company, Heron, who were in trouble, and Heron used to talk about these grounds pretty vocally and actively if you followed them over the years. When they were in distress from a zinc asset they were bringing online, Sky were clever enough to farm into this asset and do a deal. They'll end up owning 80%. There were some historic holes that had outstanding economic intercepts, think 100 metres at almost a gram a tonne, and they're currently call it twinning some of these holes and stepping out, and they've released 3 really big meterage zones, one with outstanding grade, which is due to release. The grade was so good, the recoveries, however, were poor that they're repeating one of those assays and some other step outs. And in the next couple of weeks, we'll learn whether it's more of the same. And if so, you're looking at a sizable discovery. And in our view, still an attractive market cap to be getting set in if this plays out like we think it will.
Maybe on the flip side now, John, what may not be as appealing to Paragon right now, you singled out Newcrest in one of your slides as not necessarily being as attractive due to declining production. One of your investors has asked, does their recent acquisition not play into their attractiveness in materially impacting Newcrest's future production?
The answer for me is no. I don't ever want to own a name where I'm just relying on the gold price to take it higher. And there's complex assets with declining production. What they've acquired is interesting, but it's in my view long dated. And given that they're producing they were well over 2 million ounces per annum, they need something sizable to offset the decline of what we see coming in the next 2 or 3 years, and it needs to be timely. So we'd prefer to own names where the production growth is baked in the cake, it's low capital intensity, the balance sheet sound, so they're not. I'm not relying on potentially expensive M&A and high capex and waiting a few years to see that. The names we own are all about gold price rises like we think it will, it'll be a compounding bonus to, the organic growth and growth in free cash flow.
And I'm assuming that's also the reason why you tend to avoid companies in that middle section of the spectrum that you showed us in the feasibility, funding, construction phase.
Yeah, that's right. That's where a lot of the risks can lie. There could be delays in construction, blowouts of budgets, which are common. West African, which I touched on, is an exception really. They've come in under budget and ahead of time. But yeah, that middle phase, it tends to be the boring and call it risky phase. Even when some of these projects ramp up, there can be all sorts of issues in terms of grade reconciliation, recovery, downtime, not achieving throughput, and we don't want to be sitting in dead capital waiting a long time for these investments to turn up. And so the beauty for us is there's plenty of opportunity in the other phases, phase 1 and 3.
I'd like to pick your brain a little bit, John, about portfolio construction now. Can you maybe provide an example of how you've been dealing with the rebalancing in your portfolio, given the run in many of the names that you hold? Going forward, you look to trim positions and reinvest at an earlier stage if the risk reward is more compelling there?
Yeah, so it's a little bit of both. Yes, absolutely. I'm not talking about lithium, but if you look at lithium and that gold and that cycle, we absolutely were recycling big winners into, call it, the next projects in what we thought was a stronger for longer cycle when that ran. And so we'll do the same thing here for gold. However, there are times